So now we're going to go into our weekly webinar, and we're going to follow the same format. We've got updates from the Slott groups. I'm going to give you some updates about events we have coming up. I have a piece from Heather Schreiber's Social Security Advisor newsletter that we're going to talk about. Speaking of that newsletter, when I was going through Heather's newsletter that came out about a week ago, I was inspired to create a whole separate webinar just about the still working. If you're 62 years old and you collect early and you're still earning money, what that does to your benefit. And it's a big topic, so it demands its own webinar. So we're going to talk about that in the future. We're going to talk about the markets. And again, our financial focus today is why you should fire your financial advisor. There could be many benefits to having a financial advisor as part of your retirement team. However, how can you tell if your advisor is the right one for you? So we're going to go over those questions to ask, things to look out for at about the 30-minute mark of this video. All of our videos are indexed so that you can go through and choose which section you want to watch if you're watching the recording. If you're watching live, you're riding along with us. Remember, my goals for you is listening. I want you to be inspired to make changes. I want you to open your mind to different ideas and different ways of thinking about financial planning and investing. I want you to stay educated so that you can feel confident in the plan and strategies that are in place, and stay updated so that you can make adjustments along the way as needed. If you haven't already, please hit the like, subscribe, and notification buttons. And I always appreciate that. And if you're listening on the podcast, the Not a Guru, Real Financial Education podcast, I appreciate it. And I would appreciate you sharing that with others. You know, we get more and more downloads, it seems, every month. So that's really great. And I appreciate you all for not only sharing the YouTube channel, and we get more subscribers all the time, but also the podcast. So that means a lot. Upcoming events. We are hosting another Changing World of Retirement Planning class at Mercer County Community College in Mercer County, New Jersey. And those dates are Thursday, September 4th and September 11th at 6:30 p.m. And then Tuesday series, September 9th and September 16th at 6:30 p.m. Both classes go till 9:30 p.m. There's chock full of great information. So I look forward to seeing you all there. If you've attended the class in the past and you want to come again, you can. We are limited to space. We only have 40 seats. Last time we were in this area, we sold out and had to add an extra night. We really don't have the ability because of scheduling to add an extra night this time. So if you know somebody and you want to jump on these seats, you should. It's a really great class written by my friend David McKnight. Also coming up on September 25th at 6:15 p.m., we are hosting an encore showing of The Psychology of Retirement at, again, the Newtown Theater. So this was a very well-received screening that we did a few months ago. I think it was in March. And we're showing it again, The Psychology of Retirement. Great movie. So come on out and view it with us, and maybe get some questions answered, and you get to see members of a team and me, and we'll have a good time. And I am recording and working on the advanced class series. So I've recorded a few. I scheduled another one just today, just yesterday. So we'll get that packaged up and out to you soon, and you can review that advanced class series. Next week, we are going to have Lydia Amodi, our Chief Investment Officer, on the webinar as a special guest. And so it may be the first time that many of you meet Lydia, but we're going to do a client-only webinar. So we're going to have a client-only webinar for next week. So it will not be broadcast on YouTube. It'll be an invitation-only kind of situation. I'm sorry, we will broadcast it on YouTube, but it'll be restricted. It'll be only an invitation only. So you'll have to have the link, is what that means, to see that. So you'll need to be on our email list. If you're a client, you certainly are, and you're going to need to access it via the live link on YouTube. So one of the things that we're going to go over next week in more detail are our buffered ETF strategies. So we use in our early segments, we use buffered ETFs. So what do I mean by early segments? So segment one currently is cash and money market. While it still can be So that's usually for the first 3 years of drawdown. Segment 2 and 3, or from 3 years all the way out to 3, 4, 5, 6, 7, 8 years. So so from 3 to 8 years or live segment 2 and segment 3, and we introduce some stock component in there. So now when we introduce stock component, we want to be mindful of risk, and as part of the allocation into our stock, we use something called buffered ETFs. So I just want to show you quickly. We closely monitor these ETFs for during their outcome period. So the outcome period is 1 year. So they're issued. You might have ETFs that are issued in August and they run till next August, but we can trade them intra-year. And there are triggers that we have that may prompt us to trade them because we want to protect both the downside, the buffer, and get as much upside as we can. So we set a standard. So those ETFs that have reached about 80% of their upside, because they can be capped, say 15% on the upside, for example, 15% on the upside, 15% on the downside. So what does that mean? If we're investing in an ETF that tracks the NASDAQ, from August to August, for example, you'll have 15% upside cap, but 15% downside protection, so that if the NASDAQ over that period is down 10%, then all you really lose is the cost of that ETF. So, you're protected for the majority of that. If that index over that period of time is down 20%, well, they cover the buffer. You're down 5%, right? The difference between 15 and 20 in this example. And of course, the cost of the ETF. It buffers that downside, but we also want to avoid capping out the upside as much as possible. So I just want to share with you kind of the spreadsheet. Now I don't have, I'll share my screen here with you. What I don't have here are the individual tickers, because the tickers that you see in this reference column right here, they're the index it tracks. So this is not, this is not the ETF. And I purposely didn't list the ETF because I don't want it to be perceived as a buy, sell, or hold recommendation. This is just showing you how we track it. So this is a live spreadsheet that we use every week, and you'll see it's very simple. So we've got these different ETFs that track an index. So here, I'm just picking one here. So this is one that was issued in March. Let's see, I can draw on this. So here's one that's issued in March right here. It tracks the NASDAQ. Here's the fund price. This is these are the returns. This is the remaining. This is the remaining cap, the remaining downside, and then we have where we are. We're at 56% of the cap remaining, so we're still good. And we've got the buffer, 144% of the buffer remaining. So then it's all in the green here, right? And that where we see yellow is these are the ones that are getting close. So we may want to roll out of them. We may want to, when they trigger, right? You see here the red. Well, now we've got a smaller amount available still for the cap. So we don't want to just let the cap go through the cap rate if at all possible. We want to trade out of it, reset it so you as the client can capture more of that upside, and also reset that buffer just in case the market drops out. So Lydia is going to talk about this in more detail. I just want to kind of give you a teaser here, a little commercial. But you can see we had 27 accounts that we rebalanced out of this and reset the allocation. And qualified means IRA accounts, whether they're Roth IRA or traditional IRAs, and then non-qualified accounts, right? Non-IRA accounts we have to pay more attention to. So we had 27 IRA type of accounts, 2 accounts that were taxable. So we've got to be careful that we don't create capital gains or unnecessary capital gains for those clients. So I just wanted to give you a snapshot of that. If you're a client, we're going to talk more about that next week during our client-only investment webinar. If you're not a client and you want to learn more about what I just talked about, you can reach out to us at questions@attleborowealth.com. Again, questions@attleborowealth.com. If you have at least $1 million in retirement accounts, you can use the link in the description to schedule time with me for a 15-minute discovery call, and we can talk about this or any other thing that is on your mind. So now we're going to go into the Slott report. So read along with me here. We're going to talk about 5 random retirement account trivia questions, and this is by our friend Andy Ives. So Andy writes, are the current tax brackets made permanent by the One Big Beautiful Bill Act really here forever? Let me get myself out of the way here. You don't need to see me. Well, it'll make it a little easier. So are these changes here forever? Andy writes, not necessarily. The One Big Beautiful Bill Act did extend the tax rates established by the 2017 Tax Cuts and Jobs Act permanently, but that word has a different meaning when it comes to tax law. Yes, the current tax brackets are locked in, at least until a future Congress decides to change them. So leverage these low taxes for Roth conversions while they are still here, because permanent may not mean what you think. So this is really important. And here I'm going to bring myself back in. This is really important because I had some people say, well, hey, does it make sense to do Roth conversions still because these low tax rates are permanent? Permanent means nothing when we're talking about tax law. There are still going to be significant financial pressures in the future that are very, very, very likely to drive our tax rates up to levels that are going to be nosebleed levels. And you're going to be very happy, likely, that you did your Roth conversions when we have these beneficial rates. So the next point is, how old does a beneficiary have to be to do a qualified charitable distribution or a QCD? There are a number of rules governing qualified charitable distributions. The first of which is, to be eligible to do a QCD, a person must be age 70 and a half or older. But the question says beneficiary. Yes, QCDs can be done from an inherited IRA, but the same standard rules apply. The beneficiary of the inherited IRA must be 70 and a half or older to do a QCD. It does not matter if the original IRA owner, now deceased, was age 70 and a half or not. So it's a little confusing. There's a couple confusing things. Is it tied to the original owner? Can a beneficiary do a QCD? Now, I heard a financial advisor instruct somebody that you cannot do a QCD in an inherited IRA, and unfortunately that person was wrong. Again, remember where you get your information from, because not everybody has the correct information. You can really get caught up in these YouTube, and I recognize that I'm bringing myself here to you and this information via YouTube, but be careful where you're getting this education from. And as a reminder, this is education, not advice. You should treat this channel like general education for your financial well-being and your financial planning, but advice is very, very individualized. Okay, so next, what year does the age 75 RMD rule take effect? This is another one that's confused by people. Some people I still say, well, at 70 and a half, I have to start taking RMDs. Well, that was a long time ago. And then people make up ages. I know at 76, I have to start taking it. Well, that doesn't exist. The rule currently is 73. When you turn age 73, you have to begin taking required minimum distributions. Is actually April 1st of the year following the year you turn 73. But if you're born after 1960, it is going to be 75. With a little bit of a technicality, a little bit of a glitch there in the way that the rule was written. So let's talk about that. So technically, what year does the age 75 RMD rule take effect? Technically, the required minimum distribution age bumps up to age 75 in 2033. But in reality, we won't feel the effects until 2035. Why so? Well, anyone who turns age 75 in 2033 or 2034 would have already turned age 73, the current RMD age, 2 years prior, in 2031 or 2032, respectively. Therefore, these people will fall under the existing 73 RMD rule. In fact, there will be a 2-year adjustment period to the new RMD age in 2033 and 2034. To qualify for the age 75 RMD rule, you must turn age 75 in 2035 or later. Therefore, the age 75 RMD rule applies to anyone born in 1960 or later. And this is, why did they make it so confusing? I don't know. We've just come along saying if you turn, the rule 75, the RMD rule beginning at age 75 applies to you if you're born after year 1960 or later. So year 1960 or later is when the age of RMDs at age 75 would apply to you. But it's crazy, right? Seeing this gap and how it's written. So does the pro rata rule apply to Roth IRA conversions if a person has no after-tax dollars in any of their own IRAs, but they do have after-tax non-Roth dollars in a 401k? It does not. Pro rata dictates that if after-tax non-deductible dollars exist in a traditional IRA, SEP or simple, a person cannot cherry pick only those dollars for Roth conversions or withdrawal. A proportionate share of pre- and post-tax dollars must be accounted for. Any after-tax dollars that a person might have in their 401ks are disregarded. Note, this is also true if a person has after-tax dollars in an inherited IRA. While pro rata does apply to inherited IRAs, those accounts are ignored when a person calculates pro rata on his own IRAs. So this, a lot of this has to do with not when we're talking about Roth conversions and the pro rata rule. A lot of it applies to when folks are trying to do a backdoor Roth contribution strategy, and people get caught up in this because they'll again see it on YouTube or read about it somewhere. And they'll say, "Oh, I want to do this. I can't contribute to a Roth directly, but I can do this backdoor Roth contribution strategy." And I did a whole video about that some time ago. So we'll make sure that we have that in a link to that video in the description for backdoor Roth IRA contributions. But the pro rata rule applies, and it stings people sometimes because you think you might be making a contribution. Say it's $8,000, you make that contribution and immediately convert it to a Roth IRA. But if you have money in IRAs that count towards this pro rata rule, then only a portion of that is going to be a tax-free conversion. You're going to have to pay tax on the original amount on that conversion. So it can really shock people, and sometimes people end up really getting stung on that one. So the next one here, can you take a distribution from a Trump account before the year the beneficiary turns 18? No, you cannot. There is currently no mechanism to withdraw any dollars from the newly created Trump accounts prior to the year when the child beneficiary turns 18, regardless of what the dollars might be used for or what the emergency is. As things currently stand, when the money goes into this new savings vehicle, these funds are on lockdown until the year the beneficiary turns 18. This includes contributions from any source, the seed money from the government, personal contributions, or contributions made by an employer or any other source. In the year the beneficiary turns 18, IRA distribution rules apply, but until then, there is zero access. The next section here is from Sarah, and this also has to do with the One Big Beautiful Bill Act and its impact on HSAs. So Sarah wrote, from a tax perspective, a health savings account can offer the best of all worlds. Like traditional IRA contributions, HSA contributions are made by the individual with pre-tax dollars. Contributions made by an employer are excluded from income, like with a 401k plan, and distributions are tax and penalty free, similar to Roth IRA earnings, if they are used for qualified medical expenses. HSA contributions are only available for those covered by a high deductible health plan. The One Big Beautiful Bill Act, signed into law on July 4th, makes some changes to the HSA rules. These changes include the following. Telehealth Safe Harbor. The OBBA permanently extends the rule allowing plans to be considered HDHPs, high deductible plans, despite not having a deductible for telehealth services. This provision is effective retroactively to January 1st, 2025. Expanded HSA eligibility. The OBBBA expands HSA eligibility to include those enrolled in bronze and catastrophic plans available on state and federal insurance exchanges under the Affordable Care Act. This provision is effective January 1st, 2026. Direct primary care. The OBBBA allows individuals with high deductible plans to enroll in DPC arrangements, sometimes referred to as concierge plans, concierge medical care, while remaining HSA eligible, provided the monthly fee for the DPC services does not exceed $150 for individuals and $300 for families, both adjusted for inflation. DPC fees are also considered qualified medical expenses that can be paid with HSA funds. This provision is effective January 1st, 2026. So also on my schedule coming up is a webinar just focusing on HSAs. HSAs are really powerful accounts that often, don't get the focus that they should when you hear about tax efficient planning and retirement planning and things like that. And some people are aware of them, some people aren't. Some people are using them for daily needs. Some people are saving their money in them. You can invest your funds in an HSA. So it depends on what your situation is that's best for you. I'll give you an example. I have an HSA that I've been funding for years, and I don't touch it. I'm saving and investing that money in that HSA for when I'm going to need it in retirement. We know that medical expenses are likely to be very expensive during retirement, so I want as much as I can. It's also kind of the perfect vehicle because you get a tax deduction for your contributions to an HSA, and it comes out tax-free for qualified expenses. So I like to fill those up as much as possible and have that money grow tax-free and have the benefit of that in the future. But it's different for everybody. You should never do anything because of the way I do it. But you've got to, when you're doing your retirement planning, and especially if you're still working, we'll talk about this a little bit in our upcoming financial focus. But you want to make sure if you're eligible for an HSA that you're taking advantage of it. So future change is possible. While the impact of the One Big Beautiful Bill Act on HSAs is relatively minor, earlier drafts of the new legislation included much more sweeping changes, such as much higher contribution limits and allowing HSA contributions while on Medicare. Just because these provisions were left out of the final bill does not mean they will be abandoned. It is likely that provisions expanding HSAs will reemerge in future legislative proposals. So that's from the Slott Group. Let's go into Heather Schreiber's report. So this was a part of her mailbag. So when somebody writes in, we didn't do the Slott mailbag today. We did just captured a couple of the Slott reports. But Heather also has an advisor mailbag. So this is when advisors from around the country will email into her, and she'll give some answers about Social Security. And just as a reminder, we talked about it last week, but if you're a client of ours, Heather's part of our team. Heather reviews the Social Security planning strategies or Social Security withdrawal or distribution strategies for each one of our clients. And her advice is just really, really valuable to us all. So Heather, if you're listening, I thank you. And this question came in. I'll read it to you. So read along with me here. Is, Dear Heather, my father-in-law never earned enough credits to qualify for his own Social Security retirement benefit. He worked his entire career in a public sector job that didn't withhold Social Security taxes, but he does receive a pension from that work. He recently turned 70 years old and just found out that with the repeal of the government pension offset, the GPO, he's now eligible for spousal benefits. Is it true that because he didn't apply for benefits earlier, since he knew he wasn't eligible before, he may not be able to receive retroactive benefits back to January 2024? That doesn't seem fair. Signed, seriously? So, yeah, this is one of those things, if anytime new legislation comes out, and I'm hearing our CPA and tax planner in my head, Sasha, just saying, these folks in Washington write these bills, and then it has all this crazy language, and then the IRS and the government agencies have to figure it all out and correct it, and sometimes that takes years. And this is one of those issues, and it's kind of absurd. But we see these from time to time. I was talking to a police officer at a local municipality here, and he doesn't have Social Security benefits because his pension, his municipality didn't pay into Social Security, and he would not have been able to collect spousal benefits if this new law was, or if this wasn't passed. This provision, the government pension offset. So the answer to this question, Dear Seriously, the way the SSA, Social Security Administration, is currently administering retroactive payments under the Social Security Fairness Act has been strict. In general, retroactive payments back to the law's effective date of January 1st, 2024, are being granted only to individuals who had already filed for benefits but were either denied due to the GPO or received partial monthly benefits. In other words, they had an application on record but received no payment or reduced payment due to the GPO provision. The same application of the rules applies to those who are eligible for increased benefits due to the repeal of the windfall elimination provision. For those who never filed a claim because they knew they weren't eligible under the old rules, SSA is denying retroactive benefits because no application was filed. This approach aligns with the language in the Social Security Administration's Q&A guidance for the SSFA. In part, it states that extended retroactivity is only available to individuals who were already entitled to an income benefit but had it fully or partially withheld due to the WEP or the GPO. SSA is encouraging individuals who have not previously filed to apply as soon as possible to protect their filing date and potentially receive the standard 6 months of retroactive benefits that may be available under the standard rules. Wow, that's crazy, isn't it? So, you can't receive a retroactive benefit beyond the 6 months because you didn't apply, and you didn't apply because it wasn't available to you. But that is the craziness of government. All right, let's talk about the markets a bit. So we had some headlines today. So we saw that consumer price index came in just about as expected, right? But which was a sigh of relief because it came in 0.2% for the month, 2.7% on an annual basis, in line with general expectations. Which again, huge sigh of relief. There were some concerns that we were going to see upticks of inflation. And so now that's changing things a little bit in some people's eyes. So I'm reading some information from our analyst, Lydia, and one of her bullet points here is the odds of a 0.25% cut in September surged to 89% as of late Friday. I was reading this morning after the CPI report yesterday that Bloomberg was reporting that the odds of a 0.5% rate cut rose above 90% just with the CPI report yesterday. But prior to this broadcast, I saw an analyst report pop up that said no cuts in September. So we'll have to see what happens in September. But markets rebounded last week, Lydia writes, with the S&P 500, NASDAQ, Dow Jones, and MSCI indexes all ending positive for the note. In the U.S., much of the market's enthusiasm came because of the better-than-expected earnings and growing expectations for the Federal Reserve to cut rates in September. So again, we've got some enthusiasm because of earnings. Now we have some enthusiasm because of inflation. We have to watch out for the PPI report that comes on Thursday. But we'll see where this goes. Looking over everything, it looks green on the screen right now today as of 10/26. The Institute for Supply Management's U.S. Service Index fell to 50.1 in July from 50.8 in June. Initial jobless claims rose to 226,000 for the week ending August 2nd, up from an upwardly revised 219,000 for the previous week compared to expectations of 220,000. We talked about the expectations for the rate cuts. We had strong corporate earnings. The dollar was stable. We talked about the Dow Jones being up and international stocks. And this week, again, yesterday, we had the consumer price index. On Thursday, we see the U.S. initial claims for unemployment, the producer price index, 30-year mortgage rates, and Friday is U.S. retail sales. So we're going to have to keep a close eye on those. Now, what are the large analysts saying, the big investment firms and these large analysts? So from a positive outlook, U.S. Bank says new fiscal stimulus from the One Big Beautiful Bill Act should provide near-term growth boost even as it raises long-term debt concerns. Fidelity says global economic is broadly stable. Corporate earnings remain supportive of market strength. BlackRock says U.S. corporate earnings are strong with profit margins at record highs, largely powered by AI rally. BlackRock remains overweight U.S. stocks, especially where AI plays a role. Now, on the other side of that, so that's the optimistic side. On the bearish side of that, the more pessimistic side, Northern Trust emphasized the prolonged policy uncertainty could weigh heavily on investor sentiment, producing cautious backdrop for markets. The possibility of further negative outlook scenarios like a negative 10% market decline adds to the concerns. CFO survey, so Chief Financial Officer surveys, nearly 75% of the CFO surveys hold a negative view of the global economy. Now, this is interesting because these are kind of the boots on the ground. 55% say they are moderately negative, and 19% say they are significantly negative. Many citing tariffs, market volatility, and policy uncertainty. Goldman Sachs macro trader warned in a market note on Monday that markets appeared to be ignoring recession risk. So I always say when the big players can't agree, when BlackRock says we're overweighting U.S. equities, and then when Goldman Sachs says it looks like we're ignoring recession risk, we should pay attention to this. What do you do as a average investor? Well, you got to rely on your financial plan. Let your financial plan drive your investment strategy. Let use the structure we talk about. The 3 pillars of investment management. So we've got strong asset allocation. You have to have strong asset allocation, but you've got to do more. Principal protection, asset allocation, principal protection, and account segmentation. So that video will be linked in the description. And it's linked in the description every video because we talk about it every time. But using those principles, that helps. That helps kind of make sure that you're focused on the objective and not the noise. Because traders want to trade. Most financial advisors are focused on the growth of accounts, not the distribution of accounts. We're going to talk about that a little bit more later. So who do you follow? Goldman Sachs, Northern Trust? Do you follow Fidelity or BlackRock? They're on different sides of the coin. You don't. You listen to it, you pay attention, but you follow the direction of your investment plan, and you make sure your financial plan, and you make sure you have a sound strategy using, in my opinion, account segmentation, asset allocation, and principal protection. All right, so moving on. So here's the numbers for the week. So last week, closing on Friday, we saw the Dow Jones Industrial Average up 1.37%, year-to-date 4.85%. The S&P 500 up 2.44%, year-to-date 9.46%. The NASDAQ up 3.88%, year-to-date 11.52%. International markets incredibly strong, 2.98% for the MSCI World Index, not including the U.S., for almost a 21% return so far this year. The MSCI emerging markets up 2.32% for almost a 19% return so far this year. The MSCI Europe, Asia, and the Far East up 2.8% for over a 21% return so far this year. And it keeps rolling like that. So good positive returns we're seeing certainly around the globe, excluding even the U.S. markets. U.S. markets are doing just fine, by the way, but the international markets are crushing it. And that's one of the reasons for strong asset allocation. You can't set that aside. The bond markets were down slightly last week, 0.18% for the U.S. aggregate bond index, still positive for the year at 4.40. The 1 to 3 year index was 0.04, still positive for 3.33%. And I think that's good for the markets for this week. All right. Okay, so now let's move in to our financial focus portion of today's webinar. So today's financial focus is why you should fire your financial advisor. If you haven't already, you should hit the like, subscribe, and notification buttons. We're coming off of our weekly webinar with a lot of chock full information if you're just joining us for this part of the recording. So if you want to go back and watch that, you certainly can. But let me share with you a couple of things. The first thing is, why this topic? So, an advisor can be a valuable member of your retirement team, but you need the right advisor team for you. So why this topic is, we had a couple who attended class. They are 60 and 63 years old. They're retiring in a few years. They came with questions and concerns. So anybody who attends our class, they have the opportunity to schedule time with me for a 50-minute consultation. Now, listen, typically you hear me say, if you have at least $1 million in a retirement account and you have questions for me, you can schedule time. There's a link in this video for a 15-minute discovery call. For people who attend classes, I'm giving 50 minutes of my time for a strategy session. That's to answer specific questions you have and come up with strategies. And then also, if it makes sense, I offer another meeting. I don't charge for either one of those, where we talk about some more in-depth strategies. And we decide that together if it makes sense for us to have that second meeting. But I offer everybody who attends our classes, and I've got one coming up in September that's live in Montgomery County. We've got a webinar class coming up in later in the year or early next year. I can't remember quite which, that anybody can attend, but that's a benefit, I think, that folks have the opportunity to come with questions and really spend some time. So these people did. They came with questions and concerns. They said, what were they missing? So I have everybody fill out an evaluation form, and I asked them some specific questions. So here were their notes from class. So they came with questions. Here were their notes from the class. They were eligible for an HSA. That was not discussed, never discussed. Did they have a Roth 401k? Never discussed, is what they said to me. I never considered this. I don't know if we have a Roth 401k. That is an ongoing thing that I hear. When I ask the question, do you have a Roth 401k in class, whether it's live on webinars, some people raise their hand. Yes, more and more people are learning about it, but a lot of people don't know. There is tremendous benefit if you're still working and you have the funds to contribute to making sure that you understand if you have an opportunity to contribute to a Roth 401k or not. And if you don't, oftentimes you can talk to your plan sponsor about amending it. But I think it's more than 80% of the plans out there now have Roth 401ks. But this was never discussed with these folks. So they're a financial advisor. So they had a financial advisor team that they've been working with. And they told me they're good guys. We really like them, and we've been with them a long time. But they came with the questions and concerns, wanted to know maybe what they're missing. Well, they were missing the fact that they're eligible for an HSA, and that was never discussed. HSAs are huge. You get a tax deduction for contributing funds, and for qualified medical expenses, you don't pay tax on distribution of funds, and you can invest that money along the way. That's a huge missed opportunity. They were eligible to contribute to a Roth IRA because of their income limits and because of their income level, and because they had income, they were still eligible to contribute to a Roth IRA. Not discussed, never discussed. They had no, and this was the big one. So let's make these red flags, right? Let's make them red because these are red flags. So HSA, not discussed. Roth 401k, not discussed. Eligibility to contribute to a Roth IRA, not discussed. So these two things alone, Roth 401k, $30,000 plus each a year, Roth IRA, $8,000 plus each a year that they could do. These are huge tax efficient savings that they could take advantage of, and they weren't because they're financial advisors who are good guys. We've been with them for a long time. Didn't discuss it with them. Never brought it up to them. Most importantly, they had no idea what they needed to spend in retirement. So they're just a few years from retirement. Actually, it could have been as early as next year for the husband. This was the decision he made. And when I said, well, how much do you need to spend during retirement? And I don't need them to project out, what the inflation number is going to be, but what's that monthly number? What's that annual number? Whatever that works for me. No idea. Now I see this a lot. But mostly with people, well, both sides of it, right? I see this a lot with people who are either trying to do this themselves or, believe it or not, who are working with financial advisors. And what most, and I've shared with you that I have the opportunity to coach advisors around the country. And what I hear over and over again when I ask them, how do you determine how much your clients need to spend in retirement? They say, I ask them. Well, of course you have to ask them. And then I say, okay, well, they come back and tell you $10,000 a month. What do you do? They said, I put that into my program. Well, that is never the answer. $10,000 is almost never the answer. It's a common answer, but it's almost never the answer. You have to do the work. You have to dig in, do the work, go through the process. We have a spreadsheet that we've developed that helps people shake the trees on their expenses. there are things in there that people always say, oh, geez, I wasn't considering that. So often that $10,000 a month turns into $12,000 or $13,000 or sometimes $16,000 a month. And those, even a small difference can have a big difference in retirement. But these folks had no idea what they wanted to spend in retirement. They had been working with the financial advisory team for years. They're good guys. They thought they were being taken care of. They didn't discuss HSAs. They never discussed Roth 401ks. They never discussed eligibility to contribute to a Roth IRA. They had no idea what they need to spend in retirement. Were these folks ready? No, not at all. Well, so I see all these red flags. We go through and I offered them that second meeting. I did an analysis for them. I showed them a tax efficient strategy, potentially earning them more, $1.1 million more by age 85. $1.1 million more by age 85 using the strategies that we use. Now, listen, this is not a commercial for Attleboro Wealth Management. I'm just trying to show you the difference between an effective financial advisor and an ineffective financial advisor and team. So we're potentially showing them $1.1 million more. We're addressing, of course, we asked them about their HSA. I spent time with our CPA or in-house CPA because there were some questions about timing of eligibility. So we got an answer about timing of eligibility. Of course, we wanted to take a look at their Roth 401k and make sure that they're contributing as much as they can to their Roth 401k. Of course, we want to make sure that they're contributing to their Roth IRA. And of course, we have a Roth conversion strategy as well. And we want to, in a financial planning process, we really want to determine clearly what that need for income is. And we want to review it every single year. But just using the basic tax efficient strategies, we show them that $1.1 million can either be in their accounts or spent during that time from now until age 85 just by using these strategies. So that's all good, right? That's all positive. So I'm jazzed up about this, and I think this is a great opportunity for these people. We discussed our 8-week financial planning process, this in-depth process where we meet every 2 weeks. We shake all the trees. We identify their goals, needs, and issues, and we make sure that they are fully loaded and ready when they pull the trigger, make that decision, walk out the door, headed into their retirement. We discussed our investment strategy, the 3 pillars of investment management, asset allocation, principal protection, and account segmentation, a unique strategy that most people don't do because it takes so much time and effort, as well as the 8-week financial planning process. Most people don't do because it takes so much time and effort. This, again, isn't a commercial for us. I'm just explaining to you what we went through. So we explain all of this in detail. It's all on our website. We shared it. You can view it. You can view our website. I'm going to show you here. You can go to attleborowealth.com. You can view our systems and processes on our website. But back to this issue here. So we go through and we look at, and they said, wow, this is really something. We really see the value here. There's a lot going on. And, I just can't believe we haven't talked about these things before. Let me check in. Let me come back. And that's normal. And listen, folks, we do not pressure people here. And we want to make sure that we can be impactful for people that we're potentially working with. And the people who we're going to potentially bring onto our firm as clients, I sure as heck want to make sure that you understand the potential impact and $1.1 million and clarity, right? Clarity around things. I always talk about having the clarity to give you the comfort you want in retirement and the confidence that you're going to make it. So $1.1 million, you don't have to wait until age 85 to just have that in your accounts. You can spend it during that time. But if you're not clear with that and you're not ready to make a decision at that point, I completely understand that. So we present this strategy and we never pressure people. And I say, okay, let's have a go, no-go meeting. So we schedule what I call a go, no-go meeting, and we follow up a couple weeks later. And that gives people an opportunity to just, think about it and watch other videos that we have, really learn more about us, maybe read a book or two. And I tell people, with the nice thing about the go, no-go meeting, if you're not ready to move forward, you can just cancel the meeting. Really, if you decide otherwise, just cancel the meeting. It's okay. So the time comes for the go, no-go meeting, and these people get on and they say, hey, I want to thank you for your time. We've decided to stay with our current advisors because they're good guys. So they're good guys. We've been with them a long time. They say they're already doing everything you said you're doing. Now, remember, let's go back. They had eligibility for an HSA. No idea. Never discussed. They had eligibility for a Roth 401k, or they potential eligibility for a Roth 401k. They have no idea. Never discussed. They had eligibility to contribute to a Roth IRA. Never discussed. They have no idea what they need to spend in retirement. It could be $80,000 a year. It could be $150,000 a year, and they have no clue. Yet, these people say they're doing the same thing. They use financial planning software. Well, let me tell you something. So they say they are doing this. We're going to keep this black. They say they're doing everything. They said to me, well, they say they use financial planning software too. So everybody uses financial planning software. It's not about the software. It's about the process. You've got to have a process, a repeatable process that is detailed and formalized so that it shakes those trees. It identifies those goals, needs, and issues. They also are now doing Roth conversions, and we did one last year. That's great. That's one piece out of the pie. And I just wrote, this couple won't ever be able to correct, and they're potentially leaving $1 million or more on the table for themselves or their family because it's more comfortable than changing. It's more comfortable than changing. They're good guys, and they've been around. We've been working with them. Now, I tell you this because I just want to bring you the backstory and why this is. Now, normally, listen, this happens, and it happens, a few times a year, and I just kind of forget about it. But I feel so bad for these people that I just wanted to share with you. They should fire their financial advisor. So why should you fire your financial advisor? Well, I think it should be obvious at this point, but I wrote some things down here. So reasons to fire your current financial advisor: lack of experience in what you need. So most advisors are very, very good at helping you grow your investments, right? Helping you climb that mountain. And it's about the percentage growth, and you might have some great percentage growth over time. Well, now you reach retirement and you have to come down that mountain. What is the most efficient way to draw out of all your different accounts so that you can retire with the comfort and the confidence that you deserve? That's where most people are lacking. Right? That is where most of the training and most of the education in this profession of ours and the expertise is missing. They're lacking financial planning. They may have software that they use, but trust me when I tell you, most financial planners, their financial plans are razor thin. You really need to dig in. You need to have a process, a formal, repeatable process that is reviewed every single year. They should offer tax planning. This is one of the most expensive items on your expense list, right? That you're going to have in retirement. And most advisors say, we're not going to talk about that. We do not offer tax advice, they say. You want a team that offers tax advice, like a team like Attleboro Wealth Management. Again, this is not a commercial for us, but you want a team that offers tax planning. Retirement income planning, coming down that mountain, very, very, very important. It can be millions of dollars difference over your lifetime, just how you draw your money out. So if they have no experience and no expertise in retirement income planning, you're going to want to make a different decision. And then, of course, risk management. And risk management in a withdrawal strategy, it's not just about we've got buffered ETFs, or we've got a principal protected fixed index annuity or something like that. Both of those things are good, but you need the entire strategy, the entire withdrawal strategy that is going to manage your risk. Education and qualifications. We talk about your retirement team, and we've got a video on that. Your financial advisor should be a certified financial planner. Why not? That is the gold standard. That is the most difficult planning designation in the industry. It's the only independent board certification out there. It requires not only education, but a significant test of proficiency. And that advisor should not only be a CFP, and also there's ethics requirements. So education, proficiency, and ethics. But that person should also focus on what you need. In this case, it's retirement income planning, right? So retirement and tax efficient, we'll call it tax efficient retirement income planning. You should also have a CPA on your team, and you should also have an attorney and and I think an attorney who focuses on elder law. And all those people should be working for you, working together for you. So if you want to learn more about that retirement team, I have a video for that. We'll make sure that that's included in the description here. But you want to make sure that your team has the education and qualification. The team also is qualified, educated, and experienced. We want to make sure we have experience here on either side. I was listening to somebody on either a podcast or a book, and they say, you don't want to be your plastic surgeon's first patient. And I thought, geez Louise, isn't that a true story, right? So we don't want somebody like this group. Well, hey, thankfully Roth conversions are starting to get more popular out there. People are starting to jump on the bandwagon, and that's a good thing. Now, we've been specializing in tax efficient strategies and Roth conversions since about 2012. And we've got a good length of time and experience across all of our team in that. But, we certainly don't want to be you don't want to be your plastic surgeon's first patient for sure. So make sure your advisor and your team is qualified, educated, and experienced. Make sure they have resources like the Slott group. The Ed Slott Master Lead Advisor Group or a Lead Advisor Group is the only group I know out there that brings us constant and continuous updates on tax law changes, on IRA distribution strategies. They have analysts that are available to us all the time to answer complex tax questions and distribution strategy questions. I don't know how we would do what we do as effectively without the Slott group. So they should have resources like that. They should have a process, process formal and repeatable. If they don't have these things, if that's lacking, you should fire them, right? If there's no process, a formal, repeatable process that's significant and deep, you should fire them. If they don't have the resources of something like the Slott group, unfortunately, the Slott group's the only one I know about, but if they're not involved in the Slott group, for example, you should fire them. If their team isn't qualified, educated, or experienced, find somebody else. If they're not offering these things, if they're inconsistent, if they don't have the consistency needed to have your financial planning reviews every year to make sure you're staying up to date, to make sure you're not missing things, consider change. Change is uncomfortable, but it can be for the good, for the better for you. If their fees are too high, evaluate your fees. I don't know how many people I talk to when I ask, well, what are you paying your current advisor? I don't know, they say. Well, our clients receive a fee report every quarter. I hope that they're reviewing that. We review it for sure. It's a detailed fee report. We talk about it during our portfolio reviews. And we're always making sure that I know we're competitive. And in fact, I know that we're giving much greater value than what any clients are paying us. But not only the advisor fees. Now, there was a study done by a company called SEI many years ago that showed that if an advisor is just giving you investment advice, the value of that is 0.25%. If it's just investment advice, how you should invest your money, not tax planning, not financial planning, in-depth comprehensive financial planning, if it's not tax planning, not financial planning, not making sure your insurance policies are all online, estate planning, working with your other advisors, your tax planner, your attorney, all those different things. If it's just investment advice, the value of that is 0.25%. Where most financial advisors, if they're just giving investment advice, are charging more like 1% to still, believe it or not, 1.5%. Holy cow. That's crazy. The value and the difference between the 0.25 and the 1, so we start at 1%, for example. Again, I'm just using us as an example. That difference to that 0.75%, we bring that value in our tax planning and our financial planning strategies and working with the other advisors in the estate plan. Just like last week, we had a client who had just done their wills not long ago, about 5 years ago, and they had significant issues with the structure of their executors and their power attorney agents. That could be a real problem for them. Well, they're new clients, and if we didn't see that, and one of them or both of them, heaven forbid, passed away, there would be real issues. So that's all part of it. That's where you bring the value as a a higher performing financial planning team today. So if you don't have that in your existing team, fire them. Investment fees. Holy cow, pay attention to those investment fees. So investment fees can range as low as 0.03% to as high as, I don't know, you name it, an average of probably 1% in addition, right? 0.3%, 1% to 2% plus. So you got to pay attention to those investment fees. So their fees can be too high. Now, this use of third-party money managers. Many investment advisors will say, well, we're going to take your $2 million. We're going to charge you 1% on that. And then we're going to farm that out. We're going to send that to BlackRock, for example. This is nothing. I'm just using it. It could be Vanguard. It doesn't matter. We're going to send that to XYZ firm. They're going to manage your money. We're going to watch it from afar. We're going to take a consultative approach. We're going to watch it. We're going to make sure that they're doing a great job. And we'll make changes as we need to. Well, that sounds great. But the problem is that, so now your advisor is charging you, let's just call it 1%. They've sent that to the third-party money manager, and they have another fee. Sometimes it's called platform fees. Sometimes it's called management fees or something like that. So we've got 1% here. Then we potentially have another 0.25, sometimes 0.50, sometimes 1% again for that third-party manager, and it doesn't stop there. And then we potentially have mutual fund or ETF fees on top of that can range, from 0.03 all the way again to 1% or more. So it's really hard to overcome all those additional costs in these third-party money managers. So that's the why behind this, because it can be much more expensive. And when it's much more expensive, it becomes much less efficient. So if your advisor, your current advisor, if their fees too high, if they're using third-party money managers, you should evaluate that. It may be a reason to make a change. So what should you do? Well, you should challenge your comfort. You should look out for your best interests, and don't choose the most likable advisor or team. Choose the team that will not leave you asking, what have I missed? Somebody said, I was on a group call of advisors, and someone said, a happily married person doesn't go out to the dating scene just to see how things are. If you're going to events, if you're visiting other advisors, there's something there, and you should dig in and see and do a true evaluation. So I hope you can take this information, why you should fire your financial advisor. Go through this. This is why I like sharing this. You have a checklist here. I gave you the backstory of why this came up. I wish these people well. I really do. I hope they have a successful retirement. I worry about them. I worry about these folks who miss an opportunity. If you're evaluating your current financial advisor, go through these things. Make sure they're not lacking experience in what you need: financial planning, tax planning, retirement income planning, risk management. Make sure they're not lacking education and qualifications, experience. Make sure that their team is qualified, educated, and experienced. They're not lacking resources. Ask them these questions. What are your resources? They're not lacking process. Ask them, what's your process for financial planning? Well, we load it into a program. That's no good. That's not enough. Consistency. Are they lacking consistency? They should be reviewing your financial plan every single year. Are their fees too high? Ask them what their fees are. Have them justify their fees if you think they're too high, or at all. If they're, if their fee is the lowest around, have them justify that as well. Do they use third-party managers? Why do they use third-party managers, and what's the value, and what's the additional cost? I asked a couple members of our team what we thought, and I thought they were great, so I'm gonna share them with you. So our lead planner, Emily Wheeler here, I said, I'm building up this webinar. What do you think is our reasons that someone should fire their financial advisor? Emily wrote, lack of transparency, poor communication, failing to explain strategies in plain language, unwillingness to answer questions, not providing regular, clear portfolio summaries, no clear personalized financial plan, overly aggressive or overly conservative approach without justification, chasing trends rather than using disciplined, evidence-based strategies, and limited investment options. All great. They're all great points. Then Sasha responded. So Sasha's our CPA and our senior tax planner, or our tax planner. Sasha wrote, taking from a recent review, not listening to their clients, lack of flexibility, lack of truly caring for their clients' well-being by just telling clients things they want to hear. Like, just stay the course. Markets will always recover. Jeez Louise. Don't, some advisors say, don't look at your statements. Holy cow. If the markets are down, we've had a nice run, right? But when the market drops, look at your statements. Don't listen to anybody that says, don't look at your statements. Look at your statements, pay attention to what's going on. So Sasha said, just going back, just telling clients things they want to hear. Like, sure, it's okay to buy that big house. We've had that conversation a few times. In other words, he says, honesty. Honesty. Very, very important. So Jesse's one of our newer financial planners. He came from Vanguard. I'm going to scroll with this too. He spent 11 years at Vanguard, so he knows what other advisors are doing. He says lack of comprehensive financial planning would be the biggest one, such as not discussing tax planning or looking at wealth conversion strategies, estate planning, insurance planning, etc., versus what we offer. So he's comparing. Lack of options for clients who are more aggressive or more conservative, such as trying to fit all clients into a 50-50 portfolio, no matter their risk tolerance or their needs, right? It's not just all about the risk tolerance. Poor communication, not educating the clients on why they are implementing the strategies they are and why they are for their benefit. There should be an attempt made for clients to understand their plan, and many do not do this. Many advisors don't do this. Advisors who market time as part of their strategy or use tactical asset allocation, which is still market timing. Advisors who use expensive funds when cheaper alternatives exist. Advisors who do not have a long-term vision, such as ours, to invest clients for the long run and reduce their taxes upon entering a higher tax environment in the future. So I appreciate my team for their contributions. I hope that was helpful. I know it is a big topic. You can always go back and watch this recording. I appreciate our time together. I look forward to seeing you all next week. Again, next week is a client-only webinar. We're going to be talking in detail about our investment techniques and topics. We're going to have some market updates. If you haven't already, you're all going to meet our new Chief Investment Officer, Lydia, and I look forward to seeing you all next week. Have a great week. Take care.